Hello, YouTube. I'm back from vacation, and some may expect that I would come to some sort of grand revelation, jump on the bandwagon, and get super long. That did not occur. We're going to get into the market stuff in a second. It's not like I didn't do any reflecting. Something I did do reflecting wise is realize and reappreciate, and this might be reflected in my videos, not for the next couple weeks because things just got a little bit more interesting, but longer term, made me realize that I need to be able to just completely step away, go on vacation, and detach and not be concerned about things and not need to worry about some CPI report, some anything like this. And I've always known this, but this was the true, solidifying factor. I want to enjoy life. I want to stay relaxed. I know you do. And that ultimately, I think, is going to make me a better investor. And I'm sharing this idea with you that we should always be positioned in such a way that we can take a week completely off. And I'm talking hypothetically without your phone. And not be concerned about some very significant hit. That's all I'm saying. Not that the market can't do what you don't want it to do in the short run. That's obviously possible. But like Warren Buffett says, there are 3 ways to go broke: ladies, liquor, and leverage. You don't want to have leverage or exposure, even if it's not leverage, in such a way that something can happen and rip your face off. So, how does that relate to the videos? Well, that relates to the videos because I may not do videos every day at some point. I think that might be a better route. I think that's going to be better for me. I think that's going to be better for you because every time I talk, I'm going to be a little bit more broad, be very consistent. I'm going to care very much about what I'm saying in terms of a longer term perspective, not necessarily, having to come up with something that occurred today or some perspective today that I need to talk about. Yes, I know a lot of my videos are repetitive. I'm sharing with you my best work, and, here I am in freaking August doing the same thing all year essentially. But I think, more selectively chosen videos may be in our future. So without further ado, let's get back into the return from vacation video. Back in the studio, spitting the beats. We're getting the Fitch Ratings credit downgrade. And in its own right, I don't think this is any, massive, super important thing that a rating agency has decided to downgrade the U.S. debt. That itself, I just saw J-Lo and Ben Affleck bike right past me, by the way. It's a coincidence of where I am. The Fitch Ratings downgrade is not, in a vacuum, life-changing. However, what it represents and the reasoning behind it, I think is quite sound. And I think one part of the reasoning maybe doesn't really matter that much, and that's the idea that, they keep coming to these last-minute deals. Excluding that, I think everything else is very important. Yes, the consumer balance sheet is strong. We'll get to that in a second. The government balance sheet is absolutely horrendous. The government income statement, absolutely horrendous. What has happened here is that the government balance sheet deteriorated and the life force that was in it has shifted to the consumer. The problem with that is the consumer, when you lend to the consumer, people know that there's risk. They calculate for risk and they act accordingly. The reason why the Fitch downgrade is important, is because everyone's treating the atrocious balance sheet and the atrocious income statement like it's Goldilocks, like it's perfect, but it's not. It's not. I don't know any consumer who 20% of their income is interest expense. That's what it is. That's what it is. Who has such an aggressively terrible debt to income ratio. I mean, this is a seriously bad, I mean, I guess maybe not if you're looking at a mortgage or something, but it's not like, the United States government has just this massive house on the beach that it can sell. Yes, it can raise taxes, but can it just raise taxes? No. The whole notion behind adding debt is that if you add debt, you can create economic growth. And that economic growth will increase incomes and pay for the debt. However, that hasn't been happening. Unfortunately, what has been happening for a long time is that debts have been rising faster than incomes on the government level. On the government level, that's what's been happening. The reason why that's important is because the treasury bonds, the treasury bills, what comes out of the U.S. government is viewed as the safe haven. However, the balance sheet, the income statement is, if we just removed that psychology and looked at things objectively without that emotional attachment or whatever it is, we would have a very different view on lending to that body. That's the truth. So interest rates are probably a little too low. The downgrade probably makes sense. I think it makes a lot of sense. I think it should possibly be reflected in U.S. bonds, and if that is the case, all hell's gonna break loose a little bit. That's what's gonna probably happen. So those are very real things. These are not just things to go like, oh, tomorrow we'll forget about it. Everyone's talking this morning on CNBC. Oh, tomorrow, a couple days, we'll forget about it. We'll forget about it. Well, what? The government is all of a sudden going to have this magical balance sheet? They're all of a sudden going to have a fantastic income statement? No, it's not the case. So, it's just not that good. The bedrock of the financial system is actually quite weak. Pretty important thing. But let's get to the consumer because, well, the economy's strong, so we really don't have anything to worry about. All we're doing is buying stocks that pay us cash flows, and we're chilling, right? Isn't that the case? That is not necessarily true. Yes, the consumer has been strong, but there are reasons to believe, that the consumer is not going to be as strong in the future. This is what we do here. We look into the future. We look at the economic situations. Number of things have happened. COVID, like I said, transferred wealth from the government, from the people that lent money to the government, to the consumer. The consumer had its balance sheet strengthened, while the government's weakened. However, the consumer's balance sheet has consistently begun to weaken. This has happened. It's begun to weaken. Why? Because inflation was high. Inflation was high. Spending was high. People had savings. They were feeling good. The stock market was up. Their home prices were up. They were borrowing money. They were spending money. But they're definitely on their way to 2019 levels of money in the bank. However, what's below 2019 levels is the savings rate. So you have a very low savings rate and consumer savings, which are in a very straight decline. What does that tell you? That tells you the consumer was stronger in the past, is weakening, and may not be strong again in the future. That might not be the case. And then you've got student loan payments coming in, affecting 43 or so million Americans, $200 a month. All of a sudden, the savings rate is going to tick down lower, and the balance sheet is going to tick down at a more aggressive negative rate. Then you're going to have a weak consumer, and the picture is going to look different. It's going to look very different. Interest rates are going to be higher. The economy is going to be slower. Spending is going to be down. It's going to be different. You better get ready for it. The strong consumer, we don't need to worry because everything's good. That happened. We're looking into the future. It's not as bright. It's not as bright. So I'm not so confident. I'm not so optimistic. Here, I am somewhat concerned on the future. Obviously, something I've learned to appreciate more this year is time. Time for sure. I thought that these things would be more clear and seen in the market, but that was not the case. However, it's definitely happening. And that's all we can do is talk about it, tell you about it, and ultimately see what happens. But that's what I'm seeing. That's what I'm seeing out of this consumer. It's going to begin to weaken. And it's not going to be the best thing in the world, is it? It's not. In 2007, the economy was very strong. Consumers were booming. They had home equity home equities going up, meaning their net worths were going up. Spending was strong. Earnings were strong. It was the same situation. Strong economy, strong consumer, nothing to be concerned about. Boom. Then there was shortly everything to be concerned about. I think we might be in some sort of everything bubble, and I think we're seeing signs of it. Excuse me, I'm going to cough real quick, but then I'm going to share something really important. Have you ever seen another time in history where auto loans, or cars rather, increased so much in price? This has not occurred, but it has occurred in recent times, just like it did in the home bubble. Something that is occurring right now is that, believe it or not, this is not something you see in a new bull market. Auto loan rejection rates are at all-time highs. What does that mean? That means people who bought cars are showing signs of weakness, and the banks don't want to lend to them. And why is lending so important? Because it's just like printing money. The effect it has on the economy is just like printing money. So you're seeing record high auto loan rejection rates. Autos are assets for people. They can sell them. Car dealerships can sell them. It moves money around. You have less loans. You have less movement of money. You have less spending. One person's spending is another person's income. And then all of a sudden, you get the other side of the debt cycle. This is what Ray Dalio talks about all the time. Go watch his videos if you haven't seen them. They're very good videos. And I highly recommend them. Makes a lot of sense to me. He's very experienced. I will take his word on these kinds of things. And we have seen them play out repeatedly throughout history, and I think we're going to see them play out again just about here in various different ways. That's my theory. We'll see what happens ultimately, but that's my theory. And we made a video about Discover. They are increasing credit loss provisions. The consumer looks like it's going to continue to head towards a weaker state. Make of that what you will. That's today's video. Until next time, peace out.